So, remember last time we were talking about hobby losses. So we're going to pick back up with that conversation and we're going to do a problem. So remember, last time we were discussing what is and is not a hobby. We said the first thing to consider is the presumption, which is profit 3 out of 5 years or 2 out of 7 for horse racing. If you can meet this presumption, you are not a hobby. Okay? You are not a hobby if you can meet this presumption. Unless you can meet the factors, 9 factors. So these factors are used in 2 ways. Either you meet the presumption and the IRS disagrees, so they use the factors to overcome the presumption, or the taxpayer doesn't meet the presumption and they use the factors to overcome it to say, hey, I'm not a hobby. Does the taxpayer want to be a hobby? No, you don't want to be a hobby. Why? Because if you are a hobby, you can only deduct hobby expenses to the extent of hobby income. So what you are trying to prove with this presumption or with the factors is that you are a business, right? You're not a hobby. This isn't just for fun for you. This is a business. You need to make money. This is part of your livelihood. But if the IRS says, no, you're a hobby, then that means you can only deduct your expenses to the extent of your income. Well, there are further limits. Your deductions are itemized. So you must itemize your deductions to be able to take advantage of even deducting them. And they are subject to a 2% floor. If you look, I'll tell you what, we'll look at Schedule A in a minute when we go through a problem. So this is what we talked about last time. Now we need to do a problem. This is on page 619, example 24. Jim, the vice president of an oil company, has adjusted gross income of $80,000 before his hobby income. It doesn't say that in the problem, but it should. Okay? He's a VP of an oil company, and he also likes to paint on the side. He sold his paintings and made $8,860 last year in painting income. We are to assume that this is a hobby, not a for-profit endeavor, okay, not a business. He already has a full-time job. He would have a hard time arguing that this is not a hobby. Okay, this is a hobby. So now what we need to do is consider what are his deductions that he can take. What's the limit that he has? Only to the extent of hobby income. Now, I think I discussed this last time. If I didn't, I'm discussing it now. There is a pecking order for deductions, for hobby deductions. You first have to deduct your mortgage interest and property taxes. You always go here first. So, let's look at the facts. He has taxes and interest of $12,000. but it says in the facts that only 10% of his house is used as an art studio. So, is he going to get to deduct the full $12,000 here? No, only 10%. Why? Because only 10% of his house, and the deduction for mortgage interest and property taxes is related to your house. Only 10% of your taxes and interest are related to this hobby, right? 10% times $12,000 is $1,200. So he gets a deduction of $1,200 for these property taxes, which leaves us $7,460 of income left to offset. Now, the second category for deductions is basically all else except depreciation. Okay? So what else does he have here? He has frames of $1,800, art supplies of $900, fees paid to models of $4,000, and total home and maintenance costs of $4,600. So he basically has $1,800 for frames, $900 for supplies, $4,000 to pay your nude models, and let's see what else. Maintenance and utilities. It says in the problem that he has $4,600 of maintenance and utilities related to his house. But how much is his deduction going to be? 10% of that, right? Because he is only using 10% of his house as an art studio. So we're going to get, basically we're going to get 10% of $4,600, which equals $460. So these are all categories in category 2. The total of this is $7,160. So that leaves us income of $300 left for offset. The last category is, what do y'all think it is? Depreciation, right? Okay, depreciation. He has depreciation of $500. Note that this number of $500 we've already considered the 10% rule. So depreciation relates to his house, right? You depreciate his building, the house. But since he only uses 10% of it for an art studio, he only gets 10% of his depreciation. And this problem, they have already calculated that 10% for you. So if you can see right here on page 619, it says calculated depreciation on 10% of the home. So this input has already been calculated for 10%, okay? Which is $500. Is he going to get to take the whole $500? No. How much does he get to take? $300. That's right, because he only gets expenses to the extent of income. Now he has $200 left of depreciation. He does get to carry that forward. So he can use this excess later if he has the income to offset it. Does everyone understand at this point? Yes.
Where did that 4,600 come from again?
This is the number for maintenance and utilities.
Okay. And you take 10% because it's in his house. And
Yeah,
use 10%.
because this expense is related to his house, right? Which makes sense Taxes and interest are related to his house. Depreciation is related to his house. Art frames and models, that's not related to his house. Okay? If it's related to his house, we have to consider that 10%. Okay? Now, he has 200 carry forward. Now, there are a couple things I want to talk about this problem that are important. The first thing I want to talk about, mortgage interest and property taxes. If you look at a Schedule A, which is the schedule we use for itemized deductions, we're talking about lots. By the time we get to the chapter on itemized deductions, you'll already know everything. Not really, but, okay. If you look at a Schedule A, line 6 says real estate taxes. And line 10 says home mortgage interest. If this taxpayer chooses to itemize, he gets to take an itemized deduction of $12,000. It has nothing to do with having a hobby. If he itemizes, he gets the $12,000 deduction. So what's important to note here is although he only gets to take a $1,200 deduction as a hobby deduction, he really gets to take the full amount of $10,800 as an itemized deduction on Schedule A. So whatever is left, he still gets to take this deduction. It's just not a hobby deduction. It's a regular deduction on Schedule A. And actually, now that I'm thinking about it, we'll talk about it in just a second. Now, remember I said there is a 2% floor, right? If you're looking at a Schedule A, look at line 23, down here at the bottom, okay? Line 23 down at the bottom is where you would basically enter all these other expenses. And if you look at line 26, it says multiply by 2%, etc. So this category and this category are subject to the 2% floor. Not this category. This one and this one. Why is this one not subject to that 2%? Because if you look at the Schedule A, mortgage interest and taxes are up here at the top. And they're not subject to that 2% limit, which is one of the categories at the bottom. Which is one of the reasons why we require breaking it out. We go with this deduction first, because this one is not subject to the 2% floor. We go with this one last, because if you don't use it all, you get a carry forward. And then we have everything else in the middle. That's why it's important that we separate the categories of deductions. So, let's calculate our 2% floor here. Now, it's 2% of adjusted gross income. What is his adjusted gross income here? $80,000. $80,000 plus, that's right, income from his hobby. He includes that in his adjusted gross income. So he has $88.60 of AGI times 2%, which equals $1,773. All right. We basically have $7,160 of deductions in this category and $300 of deductions in this category. So that equals $7,460, which is subject to reduction under the 2% rule. So how we do this is we say, this is similar to when we were calculating phase outs. Okay? They only get to take a deduction to the extent that this amount is greater than 2% of his adjusted gross income. So we say 7,460 minus equals 5,687. Do you understand how I'm getting this? Why we have to do it this way? Basically because the code says. He only gets to take a deduction to the extent that these expenses are greater than 2% of his AGI. Okay? So, this will be the amount of his itemized deduction on Schedule A, line 23. Now, please note, something that's a little confusing here, right, is you actually have two calculations here. You have your first calculation, which with this calculation, we are not considering the 2% limit. All we want to know here, which would not, this part would not be done on the tax return. This is something you would attach as a schedule, some sort of working schedule, maybe give it to your client, maybe not. Okay, I guess if they ask for it, you can give it to them. This would be something you do on the side, and this is just to determine basically what are the numbers that we get to use, and what's the carry forward. Okay? And this piece is to determine how much the actual itemized deduction is. Right? So, unfortunately, for the taxpayer, you can't calculate this number first and run it through here. It doesn't work that way. We assume 100% here. Well, you know what I mean. If the house is 10%, then 10% of that number. But we're not doing any reduction for the 2%. This is only to determine what numbers we use to run through these limits and what number is carried forward. Okay? Now, let's say the taxpayer does not itemize. Do they get any of these deductions? No. No, they don't. Do they still have to include this in income? Yes. Yes. That is why people do not want to be a hobby. You have to include your hobby income in income, irregardless if you choose to itemize or take the standard deduction. And this 2% limit applies for this category and this category. And I actually did say this wrong earlier. The number that you would actually put on Schedule A would be the total of $12,000 at the top. It's just part of it would fall under this category and part of it would fall under the rest, but it would still be the total amount. But you have to break it out at the 10% and figure out how much income you have left to allocate to the remaining deduction. But if you're looking at actually putting it on the form, which you will not have to in this class, you don't have a hobby situation in your 1040 assignment, you would actually put the full amount of $12,000. You would put $2,000 of it on property taxes and $10,000 on home mortgage interest. And then the rest of the deductions of the $7,460 would go on line 23, which would be reduced down to $5,687 on line 27. So that's how that works. Okay, does everyone see how that works? Just Okay, good. So the next topic is closely related. It's about rental income. So there are 3 different tiers for rental income. The first one is primarily personal use. If you are primarily personal use, the place is rented for less than 15 days during the year. If you fall under this category, no rental income included, no deductions allowed. You basically have nothing to report. We just pretend like it doesn't happen. If you look, let's see, example 25 in the book is an example of this. In this example, we have Catherine, who owns a vacation cottage on the lake. During the year, she rented it for $1,600 for 2 weeks. This is how much she received in rental income. She had approximately $9,000 of rental expenses. Does she have to include this in income? No, because it was rented for less than 15 days during the year. Okay? Does she get to take a deduction for the expenses? No, but if she itemizes, then she does get to take a deduction for her interest and property taxes, right? Anything else other than interest and property taxes, no. Because remember, that deduction for interest and property taxes it applies whether you have a hobby or not, okay, or rental income or not. So, all right. Next category is primarily rental use. You must rent for greater than or equal to 15 days, because if you don't, you fall under this category. And it is not used for personal purposes greater of 14 days or 10% of the days rented. Find that slide. Now, what happens if you fall in this category? Basically, you report everything on Schedule E, okay? And you can deduct expenses over income. So basically, it doesn't matter with what your rental income is. You can take losses in excess of income. if you are in this category. Now, take a look at your 1040. If it's on Schedule E, is that going to be above the line? Or if you have a loss, let's say you have losses that are over income, is that going to be an above the line deduction or below the line deduction? Why?
Says attached Schedule E, then over
Right.
state royalties, all that.
That's right. It's line 17, right? Line 17 says Schedule E. So if it's on page 1, it is above the line, right? Okay. So, let's do a problem. Assume that Catherine, in the last example, used the, I'm going to erase this right here so I can ruin break the problem. She uses the cottage for 12 days for personal purposes and rents it for 48. So the total days of use during the year is 60 days. For this tier, primarily rental use, all we care about is the 60 days. We don't care what happens to it the other 335 days during the year. If you are in category 2, or primarily rental use, this 60 days is all we care about. Okay? So during this 60 days, or I should really say, during the year, did she rent it for greater than or equal to 15 days? Yes, rented for 48 days. Was it not used for personal purposes the greater of 14 days or 10% of the days rented? 10% of the days rented is 4.8 days or 5 days. The greater of 5 or 14 is 14. So did she didn't use it for greater than 14 days, right? She used it for 12 days for personal. So she meets this test, which is, I agree, is a little funky. The test is a little strange.
So
Okay.
with the 10% days rented, it wouldn't be the total 60 days, it would just be the 48?
48, right? The number of days rented, not the total of days used. Okay? Alright. So, now let's do a calculation. We have our rental piece, and then we have our personal piece. You don't actually have to divide it up into rental and personal, but they do it in this problem just so you can see how it works out. The rental piece is 12 days out of 60. I'm sorry, I got that backwards. 48 days out of 60, which equals 80%. The personal is 12 out of 60, which equals 20%. So now let's go through this. She has 4,800 of income. Okay, so we'll go ahead and say income. $4,800 of rental income. Now, she has mortgage interest of $6,000. So she has mortgage interest of $6,000. How much of it is going to be allocated to the rental piece? 80%, right? Because it's used 80% for rental purposes. So 80% of $6,000 is $4,800. Then Yeah, $4,800. Now, one thing you probably don't know, but I'm going to tell you now, because you need to know. This, as we just said, this is reported on Schedule E, right here. This is not a below-the-line deduction. So it does not matter whether she itemizes or takes the standard deduction. She gets these deductions anyway, okay? However, if she chooses to itemize, does she get that additional piece of $1,200 mortgage interest as an itemized deduction? Probably saying yes. The answer is actually no. This is an exception, okay? I'm sure you didn't know this, but I'm telling you now. This is an exception. She does not get that extra $1,200. We will talk about this when we talk about itemized deductions, okay? Because this deduction only applies for personal mortgage interest. The code, or Congress has said that because primarily rental use, you go past that threshold of it being a personal residence. Now it is more of a business residence. So we don't allow the deduction for the personal piece of the interest. Because now Congress says we have crossed that threshold between business and personal use with this category. It only applies with this category. Okay? Because really, it's this word personal. Congress says because it's more of a business property here, it's not really personal interest. So you don't get the deduction for that 20%. Okay, now, you have property taxes of $500. $80 of that is a deduction here, or $400. What about the remaining $100? Is he going to get to take that as an itemized deduction on Schedule A? Yes, he actually does. There's no exception. So he still does get his deduction of $100 for property taxes. This personal requirement only applies for mortgage interest, okay? Not for property taxes. He still gets this $100 deduction if he does what? Itemize, right? If he doesn't itemize, he doesn't get anything, right? The next thing. We have $1,500 for maintenance and utilities. I'll just say maintenance. $1,500. 80% of it is a business expense, which is $1,200. Then he has depreciation related to his house of $2,400. 80% of it is $1,920. Notice here, you have to go through and calculate 80% of it, okay? Because it doesn't say in the facts, this is calculated on 80% of the house. They make you go ahead and calculate 80%. Okay, so that equals a loss of $3,520. This loss is reported on Schedule E. Let's take a look at Schedule E. Okay? Take a look at it. I'll give everybody a second to do that. Schedule E, if you're looking at it, looks a lot what you just did on the board. Okay? Look here at the top. I know if you're looking at it, it says A, B, and C. All that means is 3 different properties. Property A, property B, and property C. We only have 1 property. So if you were filling out this form, you would only fill out A. Okay? So we have A, this is the physical address of the property. Then we would put the number of days it is rented, the number of days it is used personally. Then you would go through for column A, which is property A, right here, starting at line 3. And you would enter the information just like we have done right here on the board. Exactly the same. Okay? It's really pretty identical. And then you would see line, and this actually includes royalties too. This first page of this form includes royalty income. We don't have any royalty income. We're only looking at rents, okay? And then if you look down at line 26, you have your total income or loss. And then it says, include this amount. It says, enter this amount on Form 1040, line 17, which was the number that Ethan just drew our attention to on page 1 of the 1040. So that is how it would flow through and what it would look like. Okay? All right. That's it for this category. Let's talk about the last category, which is a hybrid. Personal/rental use. To fall under this category, you still have to rent for greater than or equal to 15 days. That's the same. Okay. On slide 42. But your personal days exceed the greater of 14 days or 10% of the days rented. Now, notice that this is really the flip of this. That's because these are the two extreme ends of the spectrum, right? This is purely personal, this is purely rental. This one is in between these two. So you're probably thinking, well, why didn't we talk about this one second and then this one third? Well, the reason is because that's not the way ordered of the book. And I actually think it makes sense to talk about it this way. Okay? So, this one is the hybrid, where you notice you still have to rent it for greater than or equal to 15 days. Because what happens if you don't? You are automatically in this category, no questions asked. Okay? So that still has to be met. The difference is you don't meet this test for primarily rental use. And if you don't meet this test, but you do meet this test, you are automatically here. Okay? Because these are the extreme ends. Primarily personal and primarily rental. Notice it's really the same test, the second test. It really is the same. The difference is if you don't meet it here, you'll fall into this category. So let's look at an example. If you look at example 27 in the book, we assume the same facts as the problem we just did, except that she rented the property for 30 days and lived in it for 30 days. So did she rent it for greater than or equal to 15 days? Yes. So at this point she could be in either 2 or 3. But then she also lived in it for 30 days. Well, here, it is used for personal purposes for more than 14 days, or 3. 10% of the days rented would be 3. So it is used for personal purposes greater than 14 days, which puts us here. So if these were her facts, she would fall under category 3. What happens if you're in category 3? If you're in category 3, or I'll just say the hybrid category, you're still reporting on Schedule E. It is still an above the line deduction because Schedule E is. However, there are two main differences. One, you can only deduct expenses to extent of income and you must use the hobby pecking order. The book says if you fall under this hybrid one, the hobby rules come into play. I don't agree with that. The only thing that comes into play from the hobby rules is just this pecking order and that you can only deduct expenses to the extent of income. What's different with the hobby rules? The expenses for the hobby rules, what are they? They're all itemized deductions, correct? Below the line deductions. And 2 out of the 3 categories are subject to that 2% floor, right? We don't have any such limits here, okay? We don't have, these are not itemized deductions, okay? And we don't care about the 2% floor because they're not itemized. So to me, when the book says the hobby rules are turned on, is not accurate. The only thing that is turned on from the hobby rules is this right here and this right here. The pecking order, and you can only deduct expenses to the extent of income. But how they are actually reported is still on Schedule E. It is still an above the line deduction. Okay? That's important. That's really important. Now, another thing that's different from this category 2, your mortgage interest. You can deduct the excess as an itemized deduction, if you itemize. The code has said, I think this is somewhere in the regs actually, that this amount of use, this part personal, part business, does not rise to the level of a business interest, and you can still use your personal mortgage interest itemized deduction. So that's one way, the second big way that it is different from this category 2. The third way that it is different, I forgot about this one, is for the deduction for mortgage interest and property taxes. There are 2 different approaches to how this is calculated. There is an IRS approach and there is a courts approach. So the courts have done it one way and the IRS has done it another. The IRS makes the denominator the total days used. So if you will remember, in the last problem, we said that the property was used for 60 days out of the year. Right? Yes. So when we were calculating our percentage or business use, we said 48 over 60 days. So that would be the IRS's approach. The courts have said, no, that's not right. We want to do 48 over 365 because there are 365 days in the year. Please know, these different approaches are only for the deduction of mortgage interest and property taxes. So no other category. And they are only if you fall into this hybrid part rental, part personal use. Okay? That is the only time. So, let's do a problem. This is example 28. Example 28 uses the IRS way, and then example 29 uses the court's way. So let's look at example 28. We have Jason. He rents in his vacation home. He rents it for 60 days. And he lives in it for personal, or lives in it for 30 days. So we have a total days during the year of 90 days. Okay? So the first question you always want to ask is which category is it going to fall in? Of course, I've erased the categories. But is it rented for greater than or equal to 15 days? Yes, rented for 60 days. But do the personal use days exceed 14 days or 10% of the rental days, which is 6? Yes, 30 days is greater than 14. So now we know, okay, we're going to be in that hybrid category. Okay, honestly, in my opinion, it is a little bit more intuitive. It makes a little bit more sense to me to apply the test this way than it does in the purely rental test. It's the same test, right? But for some reason, it's easier for me to think of it this way, where you're saying, okay, do my personal use days exceed this threshold? And if I can say yes, then I know I'm here. And if I can say no, then I know I'm put back into purely rental use, okay? But you don't have to do it that way. I'm just telling you that it's easier for me to think of it in terms like this, because the test is a little strange. Okay, so let's look at the problem. His gross rental income for the year is $10,000. So this is his rental income. Actually, I'm going to scoot this over a little bit. $10,000 in income. Now, it says in the problem that he has taxes and interest of $12,410. So he has taxes and interest. Remember, we have to go through that pecking order like we did in Hobby Loss. Taxes and interest of $12,410. Now, with the IRS version, what are we going to want to multiply this by? Basically, it'll be 60 days, which is the rental use piece, over 90. Or if you're doing percentages, 1/3, 33%. The same thing. Or 2/3, I'm sorry. 2/3. So that gives you 8273. Remember, we have to go through that pecking order. Now let's go to our second deduction, which is everything else other than depreciation. We have utilities and maintenance of $2,400. Same thing, 60 over 90, which gives us a deduction of $1,600. Which gives us $127 left of income to play with in the last category. The last category, which is depreciation. You have total depreciation of $9,000 times 60 over 90, which equals $6,000. But how much can we use under this category? $127, right? Because we are limited to our income. That gives us $0 of income. And this excess depreciation that they have, they can carry that forward, which is why we do the different categories. Now, a couple things to note. What number is going to go on the last line of page 1 of Schedule E? $0. Okay, we don't get to take a loss because we are in this hybrid category. So we have 0, which is what passes through to page 1. Now, what about this extra piece of taxes and interest, or that 1/3? Is that going to be an itemized deduction if the taxpayer itemizes? Yes, right? Yes. Remember, we can take the excess as an itemized depreciation for both interest and property taxes. So we would have an itemized deduction, whatever it says in the problem, of 4137. Schedule A, itemized deduction, if she chooses to itemize. Okay? All right, now, I'm not going to work through a full problem on the court's approach because it's honestly exactly the same except for this one number here. If you're looking at the court's approach, instead of 60 days over 90, they'll use what? 365, right? So that gives you 2,040 as your deduction. This number is the same for utilities and maintenance. This number is the same for depreciation, but now you get to take all of it. And you actually have $360 income that you have to report with the court's approach. So this one number for this taxpayer made a big difference, right? And of course, the excess of approximately $10,000 or $10,370 would be an itemized deduction if he chooses to itemize. Yes?
Do you get to use either of those approaches, or?
Yeah, you can choose which one you want to do. This kind of goes back to chapter 2. I would double check and make sure whatever jurisdiction your taxpayer is in, if you're working on a client's return, make sure that that court has not said something different.
Okay.
Definitely, and that's one reason it's so important. Accountants have to be able to read case law. You have to be able to read and understand what it's saying. You have to be able to understand what jurisdiction they're in, know who the parties are. And I know you learn this in business law, and sometimes you think, I don't need to know this. No, you do. You're going to have to read cases if you're doing tax at least. So you would check and make sure your jurisdiction doesn't say anything different. And if it doesn't, run both scenarios and see which one is the more favorable to your taxpayer. Okay. That's it for that. Next topic. Go on. This is a pretty simple topic. Taxpayer's benefit or obligation. You cannot take a deduction for some expense, okay, that is not yours. So let's say father pays his daughter's property taxes. He does not get to take a deduction for that. because it's not his obligation to pay it. The only exception is medical expenses. If you pay medical expenses for a dependent, there's also an exception, although it's not listed in this chapter, tuition. If a father pays his daughter's or dependent's tuition, okay, then there is also an exception there. You can take a deduction or credit for that. Yes?
If you paid your daughter's property taxes, would that count as like a gift?
Yeah, it would be a gift, but it's still not a tax deduction.
But if it was over 14,000, then it would go towards.
Then you would have to file a gift tax return. And you may or may not pay gift taxes, it just depends upon your exemption amount, right, which is almost $6 million. So, and there is a problem on the exam where it lists a bunch of things that a mother paid for her daughter and asks how much of a deduction does she get. And for some reason, I gave this question on the exam last semester and most of the students missed it. Because there were a lot of numbers and they were trying to calculate them. And unless one of them is medical expenses, the answer is 0. You cannot take a deduction for expenses that are not actually your obligation to pay. Okay?
You said tuition also?
Yeah, tuition's also one of them, although they don't mention that one in the book. There are some exceptions for tuition, so long as they're your dependents. And it has to be paid directly to the school. I've already said this before, personal expenses are not deductible unless there is an exception in the code. Okay, capital expenditures. I want to talk about this topic. This is probably the last topic to talk about today. And there'll be maybe 10 more minutes of lecture on chapter 6 on Wednesday, and then we are going to do the sample problem. So, I want to talk about capitalizing versus expensing. Now, I have talked about this before. I think it was last week. I talked about expensing versus capitalizing. So expensing is when you get to take an immediate deduction for an expenditure, right? To take a deduction this year, great. Capitalizing is when you have to take the deduction over time. We have talked about this. We talked about it when we talked about accounting methods. Remember, if you prepay something, you may have to capitalize part of it later. So we talked about it then. We've also talked about it in this chapter under one other situation. Investment expenses. You only get a $5,000 expense up front, and anything else you have to capitalize or amortize over 180 months. So you have to wait to take the rest of the deduction. There's actually a whole lot of law out there on when you capitalize versus when you expense. The very, very broad general rule is you must capitalize if the useful life of a product is greater than 1 year. And usually repairs or reoccurring items are expensed. So for example, if you repair a roof on your business property, you can take an immediate deduction for that repair. But if you put on a new roof, now you're looking at something that has a useful life of greater than 1 year, and that has to be capitalized. What does it mean when we say we capitalize it? What it really means is you're adding to the basis the expense and then depreciating or amortizing over time. You amortize when it's an intangible asset. depreciate when it's tangible. It's the exact same thing, different words for if you're talking about intangible versus tangible assets. Okay? The calculation's done a little differently, but it's the same thing. So, let's look at a really simple example. There are hundreds of pages of exceptions in the regs on this. Okay? I'm just talking about this at a 5,000 foot level. Okay? Which is all they really talk about in the book. So let's say you purchase a building and you spend $500,000 on this building that you're going to use for a business. And then this building needs a new roof, so you spend $100,000 for the roof. Okay, so now what's your basis? $600,000. Because you do not get to take an immediate deduction for this $100,000, it is capitalized or added to your basis. And then over time, you would depreciate it. We will talk about depreciation very soon. All that means is over time, you will take a deduction for this expenditure. You don't get to take an immediate deduction of it for it. But what happens if instead, this is an example the book gives, instead you bought land. And then you had to pay $100,000 to tear down a condemned building on the property. It's of no use to you. Now you still have a basis of $600,000. However, land is not depreciable. Ever. Okay? So this is not depreciable. And we'll talk about this a little more in chapter 8. Land is not depreciable. Buildings are, but not land. So what happens to this $600,000? Do you get to take a deduction for it over time? No. It just sits there in your basis. When do you see benefit from this expenditure from a tax perspective? When you sell it, right? Because when you sell it, let's say you sell it for $1 million, so you have an amount realized of $1 million. Now you have $400,000 of gain. If you did not get to add this expenditure to your basis, how much gain would you have? $500,000, right? So your benefit comes, your tax benefit comes when you sell it because you have less taxable gain, because you have a higher basis. Okay? This is because you cannot depreciate land. That's a classic example of just because you have an expense and you have to capitalize it, that does not necessarily mean that you're going to get to take a deduction for it over time. Usually it does, okay? But there are some things you cannot depreciate, land being the big example. Can you depreciate land for financial accounting purposes? Y'all know. I'm asking because I know very little about financial accounting. But I don't think you can. I don't think you can. I think it's the same rule by tax purposes as financial accounting. I know for tax purposes you can, and I'm pretty sure for financial accounting purposes you cannot. So, no depreciation for land. But you do have depreciation for the building. All right. So, that's really all I want to talk about in capitalization versus expense. Know that there are so many exceptions out there. If you ever get there in practice, you're going to need to do some research. We have two very quick topics to discuss in this chapter. Next time, it'll probably get 10, maybe 15 minutes. And then we'll talk about the sample return. Okay? All right.